Glad you guys were all able to make it. Welcome to the annual McCarthy Center Student Debate. I want to thank the McCarthy Center, especially Professor Lindstrom, for asking me to participate in this debate. I also want to thank our scholar in residence, John Cromie. I'm very excited. I've met John last year when I was out in Washington, D.C., and I think this will be a spirited debate in his honor, and hopefully he'll have some great comments for us and the student debaters after the debate. I also want to thank Professor Terry Check, who my colleague in the communication department here at St. John's, who's been helping me work with the students as they prepare their arguments for this debate. I am also the debate coach of the CSB SJU speech and debate team, which has recently revived in the last couple of years, and we're very excited to have thank you. We're very excited to have a revived speech and debate presence here on campus, and I'm happy to announce that next year we will be the host of the Minnesota State Speech and Debate Tournament. So basically all of the colleges in Minnesota will be coming to St. Ben's, and so our students will have a great opportunity to see all of the different competition from around the state. So those are exciting events that are happening, and we certainly hope we can revive some of the great history of the forum, which Mr. Cromie might remember, the great debate league and competition that used to happen annually here at St. Ben's and St. John's. In the spirit of this being a student-led and student-constructed debate, I would like to introduce Caitlin Coleman, who is going to introduce our debate topic and the speakers for tonight.
Welcome, everyone. I first want to start off with a quick round of thank yous. Thank you to the members out here. Thank you for sloshing through the rain and being here tonight and supporting the debaters and recognizing their hard work in preparing this debate. I also want to give thanks to the McCarthy Center for sponsoring this debate tonight. Also, a thank you to our two faculty members, Dr. Christy Cyber and also Dr. Terry Check. Thank you for helping us create these debates and hopefully have a spirited argument tonight. And lastly, I want to thank our scholar in residence, John Cromie, a St. John's alum from class of '64. Thank you for being here tonight. Mr. Cromie is currently the Vice President of Cooperative Housing Foundation, a world traveler of over 50 countries, and his experience will generate a valued input after this debate, and we will look forward to that. So tonight's topic is global financial markets are nothing more than a global casino. Why did we choose this topic, and why is this important? Well, daily we are being informed about the current global economic crisis, from Greece to our own backyard in Minnesota. When asked, are the global markets nothing more than a casino? We will provide two sides to this argument. They will discuss the factors within the current global market system and determine if they're beneficiary or detrimental. These factors will be speed, financial instruments, and government regulations. The debate structure tonight will be made up of 3 rounds. The first one will be first speaker will be of 5 minutes each. The next speakers will discuss for 4 minutes, and then finally the third speaker will discuss for 4 minutes. In between, we'll have a 10-minute questionnaire session where we'll have our Twitter account open, so if you have any questions, please tweet them to @EugeneJ.McCarthyCenter, and then hashtag them, please, CromieDebate. That'd be great. We're trying to incorporate technology today, and also to input, we'll have Facebook. So if you want to just leave a comment on the Facebook wall, we'll try to incorporate your comment or question. So, and lastly, if you do not have any of these technologies available to you, we will have the old-fashioned way where you can write your question in on a paper, and we will try to get to your question and answer as best as possible. So with that, let's start this debate. Thank you.
I'd like to again just offer one more quick round of thank yous to John McCarthy for coming to as a scholar in residence to host this debate and to be present in this debate, and as well as to thank Matt Lindstrom, the head of McCarthy Center, Professor Christy Cyber, and Professor Terry Check for all the help and hard work that they've helped to put in to this debate. As students, I know we all really appreciate it. Now, to get started, I'd like to emphasize the importance of the pursuit of knowledge in our daily lives. The aforementioned subject indeed allows us all to lead purpose lives and make more intelligent, informed decisions. Without the academic venue, which Mr. Cromie and all those affiliated with the McCarthy Center have brought forth, this essence of debate would be lost, and that would be a true tragedy for the Commons. Luckily, here and now, we are avoiding the nefarious possibility through which the intellectual process, or through the great intellectual process of a debate. Now, with our minds sharp and wit aplenty, I'd like to introduce the topic which we have set today on the debate floor. As Caitlin mentioned, the topic is global financial markets are nothing more than a global casino. Now, in order to understand this resolution and what it's truly asking, I would like to offer an outline of some definitions. Now, number one, global financial markets. I'd like to offer the definition that in global financial markets, as a definition, I would like to offer any organized venue, such as hedge funds or foreign exchange stocks, through which funds are transferred worldwide. Now, as a global casino, I'd like to offer up the definition of a geographically widespread game of financial chance. Now, like you know, in any casino, we have two main contributors. We have the house and we have the players. Now, in the normal casino, in the normal everyday casino that you might walk into if you're over 21, you might see the flashing lights and you know, this intense atmosphere. And that is the house, which I speak. And then the players in this casino are anybody who decides that they want to take a risk and see if they can make a buck or two. Now, in contrast, when we're talking about the global financial markets, when we speak of the house, we're talking about the system through which funds are transferred. We're talking about these hedge funds. We're talking about the Forex exchange, right? And the players are, of course, investors and corporations. Now, I'd like to offer the first point of speed and how it negatively affects the financial infrastructure that we have in place in the world today. Now, perhaps a quick thesis. Speed strikes on all tiers in a systemic and unrefined manner. It leads to a collapse of financial markets and the marginalization of less prominent players. Now, we all know this is true in a regular casino. Those who are too big to fail, those who really can go up and spend and burn a few $1,000s of cash, don't really feel the effects of the casino. Although those who are trying to make an honest living in the casino or gambling away, they end up becoming quite hurt. Now, just like this happens in regular casinos, it's also can be seen in this financial casino as well. Speed leads to an emotionally driven or irrationally driven decisions by investors. This is the first tier that I speak of. And in turn, when the investors make rushed decisions, it turns out that the corporations begin to panic, and speed is, begins to hurt the system in its entirety. Now, when the system loses as a whole due to panic and irrationality, we all lose, don't we? The extra dollar that we could be making through the system is now burned, or just as good as burned. Now, this is just like a roulette wheel spinning in a casino. You can imagine walking in and having, in this day and age, no way of predicting where the ball will roll when you throw it into the roulette wheel. It's spinning so quickly you just can't tell. Now, why is this important? Again, it harms or benefits each and every one of us, and my claim is that it does indeed harm us. Now, the system, we've seen a decline over the past few years, and as we have seen, like through different times, whenever there's an influx of information that we don't understand in the system, a sort of economic Darwinism takes place, and we end up not being able to assess the situation of our financial markets properly, and we all feel the harm. Now, the system wants to go slower in this case, and it's important to recognize that instead of deciding to keep going with the terrible action of speed, we can slow it down now and not suffer the consequences. Thank you.
Okay, first of all, thank you all for coming today, especially under this rainy weather, and special thanks to the McCarthy Center and also John Cromie for making this debate happen, and also special thanks to Dr. Cyber and Dr. Chuck, who helped our group significantly during the preparation stage. Today we come to talk about if the global financial market, nothing more than a casino. It's really important for us to talk about this topic because in the modern society, everyone is engaged in this market. For example, the change of the currency rate can double or halve a farmer's vegetable even before he harvests them. It's our job in our group to convince you that the global financial market is not like a casino in its nature. Casino is a place where people come to play for entertainment and rely on their luck. However, the global financial market is a place where we rely on rationality and can create profit for everyone engaged in this market. In order to further explain our argument, our group will talk about the distinguish between the financial market and the global casino in three aspects: speed, financial instrument, and government regulation. First of all, I want to start to explain why the speed of the global financial market is different from the speed of a casino. First, the speed of the casino is designed to make people lose their money. When we talk about casino, think about a slot machine. The slot machine is designed to roll so fast, so it's really difficult for people to get the exact same picture, so people will end up to lose their money. However, the speed in the global financial market can help a lot of companies to gather a huge amount of capital in a short period of time, so those companies can deal with the unexpected problem. The example here is that just last year, Google company issued 3 billion bonds to the market in order to get the money to pay back its short-time borrowing from other companies. At that time, most of the capital in the Google were in abroad. If the Google company tries to transfer those capital back to the US in a short period of time, there will be a huge tax put on this transaction. Therefore, because of the speed of the global financial market, Google companies can soon issue those 3 billion bonds and get those money from the market. Therefore, those Google company can pay back the loan in a short period of time and keep its credibility. The example here shows that even big companies like Google sometimes need to rely on the speed of financial market in order to deal with unexpected crises, let alone other small business firms which constantly meet unexpected crises. Second, as our opponent argued, that the high speed in the global financial market needs to net rationality, because again, it's like the slot machine when the wheel rolls so fast, it's hard for people to make the rational choice. However, it doesn't work in the global financial market in practice. Although in each second, there are a lot of transactions were made. So when you just look at each second in the market, you can see the price go up and down dramatically and quickly. However, in fact, in the global financial market, buy in and sell out happen at the same time. Therefore, unless all the investors make the same decision at the same time, the average price of the market will stay stable. Here, use Google company as an example again. This year, the stock price of Google company changed from $470 to $670, so $200 differentiation. However, the average price of Google company only changed from $580 to $620, and the change happened way slowly. From this example, one can see, although the price in each second changed so fast, but still, some people who prefer to make a slow decision can use the average price as an indicator and to invest their money in the future. Therefore there's no correct correlation between high speed and net rationality. In conclusion, the global financial market is not like a casino because it can create benefit for everyone, and also it can still make people to make rational choices. Thanks.
In one famous episode of South Park, a nearby casino buys the town in order to create a superhighway. So the eternal fourth graders, Stan, Kyle, Kenny, and Cartman, advise their parents to get all the money they have and bet it at a casino. If they were to win a game of roulette, they would have enough money to then buy back their town. They actually do win, but as might be expected from avid gamblers, they bet all their winnings and actually lose everything. This really relates to today's topic, I think. You know, the problem with the adults at South Park was that once they got a taste of victory, they just wanted more. They simply couldn't stop. You know, just look at the various teams that Peyton Manning was looking at. He wants a winner, therefore he signed with the Broncos. He wants to play for a winning team because he got a taste of victory. This is very much applicable to global financial markets, especially in their relationship with financial innovation. So my main argument, as I've hinted just now, is that when you're winning because of financial innovation, it's just really tough to stop. So, furthermore, I will try to shed light on the fact that global markets are that global markets foster a sort of addiction that is very comparable to that of a casino. So, first of all, I would like to state that an excess of financial innovation is a primary reason for some of our largest economic woes historically. And secondly, innovation is detrimental in the long run if left unregulated. My opponents are going to come up here, and they're going to talk about all the short-term benefits and all of these great examples of financial innovation. However, all of these are short-term gains, or they have been regulated innovation. So first, I'd like to define financial innovation as creating and marketing of new kinds of securities. And in order to explain financial innovation, I'm going to defer to the 2007-2008 housing crisis. So banks were lending money to people to buy a home, and they were collecting monthly payments on that. Then in turn, they were selling these loans, the money they make off that, to larger banks, and they would package these together with a bunch of other investments into what is called a mortgage-backed security. So essentially, they were just shares of a home sold off to investors, who in turn sold them off to bigger investors. It's almost like investment inception of sorts. Just an investment within an investment. So this cycle was making everyone absolutely rich, and they naturally got greedy. Once banks sold off these securities, they no longer had any stake in it whatsoever. So they really had no inclination to actually be responsible. There's no consequences. So they started giving out bad loans. And coupled with the lack of transparency, this greed that had developed, this taste of victory that made them want to keep winning, made the bigger investors simply ignore the problem. So ultimately, this led to the collapse of the dream of sorts. It led to the economic crisis the housing crisis that we know today. Other examples of financial innovation leading to crisis consist of buying on the margin during the 1920s. If you look at the stock market crash in 1929, a big causation was the fact that people were investing with money they just simply didn't have. So essentially, almost what we have is the 1% are playing a reckless game with that inevitably is going to hurt the 99%, to bring in Occupy vibes to this whole ordeal. Similarly, the adults of South Park gambled away their town in a casino. Had this action gone unresolved, they would have been displaced. They would have displaced their children and crippled their assets. On a much larger and much more disproportionate scale, the 1% has gambled away average citizens' assets. So in a comedic and happy ending, the people of South Park got their town back. While this story is very funny, the real world is far from humorous, as financial innovation has continued to lead to long-term problems in financial markets. And ultimately, these consequences are being paid by average citizens like you and I. And that is why I believe that financial innovation is ultimately very detrimental.
Hello, everyone. I as well would like to take a quick second to say thank you very much to the McCarthy Center, John Cromie, and especially to Dr. Siver and Terry for helping us so much with these presentations. We really couldn't have done it without you, and you're as much a part of the team as the rest of us. So without further ado, imagine a world for a second. Imagine the world with no form of financial innovations. You have no way to pay for anything because money does not exist. You have no way of bartering or trading. These are literally all financial innovations. Without financial innovations, the world would be stuck in subsistent farms. Everyone would have to provide everything they need for themselves and not be able to trade with anyone else. Seems like a kind of tough world we live in. However, my opponents would like to demonize these innovations, which is completely unfair. First, allow me to define what financial innovations are. Financial innovations are things such as checks, draft, bonds, or currency bills that have a monetary value or have a legally enforceable contract between two or more parties. Basically, it means that what you're holding is valuable. You can give it to someone and know you're going to get paid. Allow me to give you some examples. Standby letters of credit are an example, bank guarantees, CDs, saving loans, and the one thing that we all have, or as college students say, we don't, money. The things that we have in our pocket all the time and we use on a daily basis to keep our world functioning. There are two main reasons why these financial instruments are not part of the financial idea of a global casino. First is that financial innovations actually spread the risk around. Look to the idea of savings accounts and CDs. When you invest in these, you're guaranteed the amount of money you put in. On top of that, you also gain an interest. You help me a casino that's going to guarantee you your money back and then some on top of it. No one's going to do this. This is why our financial instruments actually do not make it a global casino. Additionally, look to the two areas that are typically demonized as a casino, hedge funds and the stock market. Hedge funds are seen as that for the 1%. Government institutes, the richest of the richest, corporations, these are considered the end-all for investors. And also the stock market, that's the one where we're allowed to play in. Both of these are considered not nearly as volatile as a casino would be. Casinos are all about risk, but if you actually look at history, hedge funds do not have the volatility that they're portrayed to be. According to a recent study by the Federal Reserve, hedge funds are actually 66% less volatile than the stock market. So how risky is the stock market, you say? Not nearly as risky as you like to believe either. Since 1928 to 2011, taking into account the Great Depression and the recent global recession, stocks on average returned 11.2%. This means even when you invest, if things go short, you are on average going to see a return. Once again, not the averages in casinos. Moving on to the second reason that the global financial market is not like a casino. In a casino, no one cares if you lose. However, in the global financial market, everyone's invested in the benefit of all. We heard my opponents bring up the idea of too big to fail. This is really true. We can see it, again, if we look to our history. Look to long-term capital management. In the 1990s, this corporation made some shaky investments and were on the verge of collapse. However, instead of allowing the market to collapse, all of their competition, you could say, or those that had even investment within the market, gave their own money to keep this corporation going as a way to bolster the market. They saw that if long-term financial capital fell, they all fell. In a casino, not the case. If I lose all my money at a slot machine or lose my town, no one's really going to care. The house is still making money. Also look to the housing market that my opponents brought up. In the housing market, we see it as this horrible thing, people losing their homes. And yes, we will not say that people did not lose their homes. However, it's an example of how it's not one against all. Everyone tried to work together. It's just as expensive for a bank to lose a loan or foreclose on a house as it is detrimental to that individual. Banks set up programs to try to help these individuals to retain their home. So clearly you can see the financial innovations are not these demonized things that my opponents would like you to believe. They're crucial to our everyday world and the way we go about our lives. And they also are not like a global casino. They allow risk to be spread around, and they also encourage everyone to take part in taking care of everyone. It's a non-zero-sum game, and without financial innovations, we couldn't have the world we believe in.
Thank you all for braving the elements to join us here tonight. Imagine a room filled with people. Bright lights flash, illuminating hundreds of slot machines and race winners. You are overwhelmed by the sounds of dropping coins, clinking glasses, and the sirens signaling jackpot winners. Now, imagine the scene transposed in front of computer screens. People shout and bells go off as investors watch the values of foreign currency go up and down at humanly impossible rates of speed. Computer algorithms are busy analyzing the number of fear words that are present in social media feeds like your Facebook or Twitter and newspapers to determine the wealth of foreign currencies in a matter of seconds. These computers work at inhumanly possible speeds akin to a Frankensteinian monster, which does not allow us to predict disaster until it is already upon us. Luckily, there is a solution to this problem: regulation in the form of a Tobin tax. First, I will describe to you one popular method of regulation the Tobin Tax, and secondly, I will show you the benefits of this regulation to the financial market. The environment that I have just described is the environment in which investors will make bets on the value of currencies in comparison to the US dollar at an extremely fast pace based upon arbitrary calculations. The solution, the Tobin Tax, was invented by an economist in 1972. This is a low-rate tax on all currency transactions, which could be as low as 0.01%. This minuscule tax is small enough not to substantially harm the value or decrease the volume of these transactions, but it would decrease the speed that market traders react to changes in price currencies. This tax would function to discourage speculative currency trading and make the market less sensitive to political news and economic policy changes. Furthermore, it would result in a revenue which could yield up to 1,000 billion US dollars in 1 year. This money could then go back into the global community and protect citizens from future crises related to currency trading. We can see a real-world example of these socioeconomic crises in Greece. Right now, the public is experiencing major socioeconomic consequences in the form of unemployment, increased taxes. The larger economies in the UN allowed Greece to hide behind the euro through numerous bailouts, even though they knew that it was not beneficial for them. And this is akin to a casino buying drinks for individuals so that they keep gambling irresponsibly. Does the Tobin tax seem crazy? Actually, it's not. It continues to be a really popular form of regulation. In 2009, the previous Prime Minister, Gordon Brown of Great Britain, proposed a global tax on financial transactions in a meeting of G20 financial ministers. This includes 19 countries with major economies and the European Union. The largest amount of time that a stock investment is held is 22 seconds. This financial market is so fast that nanoseconds become important. What is a nanosecond? I don't even know. This eliminates the ability of humans to weigh costs and benefits of their investments and to base these investments off of good information. Therefore, regulation is needed to control this monster and change the environment of these investments from a casino to a place where markets place bets on the values of currencies based on thoughtful information. The Tobin tax is therefore one method of regulation that addresses both speed and innovation, which in turn would create a stable environment with calculated investments based on credible information. Thank you.
Good evening. I too would like to extend a thank you to Mr. John Cromie for serving his residency here, to the McCarthy Center for organizing this debate, and to Dr. Christy Siver and to Dr. Terry Check for helping me prepare for this debate. I'd like to agree with our opponents that clearly, as far as global economic markets go, something is wrong. Globally, it's a financially fragile place right now. Unemployment is on the rise, and actually this morning I just read that Greece hit a record of 20.7% of their population being unemployed. As a student, I'm worried too. Will I have a job when I get out? And by the headlines, in a larger sense, it's clear that the nation is in this together. We're worried. And what I've noticed is that when a collective group of people are threatened, they look for someone to blame. They want someone to be able to point at and say, look, those are our problems. I argue that by blaming the markets, we are shooting ourselves in the foot. We need the markets, and they should be protected. My argument is twofold. Firstly, I'd like to demonstrate that casino is rooted in fun and amusement. It's a fantasy land. The markets, on the other hand, well, that's the real world. Secondly, I'd like to talk about regulation and why the government should be protected by the government instead of slowed down by ambiguous regulation such as the Tobin tax. I'd like to quote a professional gambler named V.P. Pappy. He says, "Casinos and prostitutes have the same thing in common. They're both trying to screw you out of your money and leave you and send you home with a smile." To say this is the same thing with the global financial markets is to completely reject the utility of the markets and how they help us with our daily lives, especially with the working class. Let's take, for example, farmers. With farming, there's huge price fluctuations, and farmers need to be able to hedge their risk. They need to be able to have a backstop in order to protect their operation for future business. Not only that, but protection of their families is important as well. And if you want to talk about a line of credit, talk to a farmer. Their farming equipment can often be to the tune of hundreds of thousands of dollars. Credit is a lifeline of security to these farmers and also to hard working class Americans. If the markets were a casino and big finance the players, well, the farmers wouldn't be secure, neither would our education, neither would our careers, and neither would our retirements. And now that we have established the utility of the market, let's address regulation. The government clearly has a role. Well, I argue that the largest of these is to protect the people, well, from ourselves. And I'm not going to reject that there haven't been brigands, pirates, and crooks in the financial markets, because clearly with the Petters and the Bernie Madoffs coming out of the woodwork, there's been abuse. Well, I say get them out, punish them, and make an example of them. This is where government can find their role. With electronic auditing trails, this is now possible at levels that have never been possible before. It's clear that the private sector is a much more efficient allocator of wealth than the government, and this must be protected. Some call for a redistribution of the wealth and call for the government to step into this allocation process. And I acknowledge that this is laudable and noble, but is it not more important for the working class to have stable food prices, to have stable oil prices, to have stable commodity prices? Without stable financial markets, this is impossible. In conclusion, financial markets are not like a casino. They're rooted in fantasy, and this is real-world utility that we're talking about, and it should be protected. And I would like to thank again John Cromie at the McCarthy Center, Dr. Christy Siver, and Dr. Terry Check for facilitating this debate. It's discourse like this that heightens public understanding of these important issues. Thank you.
Hello? Okay, hi. Again, once again, thank you for coming to the debate, and we have a few questions so far. We would be grateful if people could keep submitting more questions, whether through paper or likely through Twitter. We have paper over here. If you want to ask a question, though, you can also just raise your hand, and I can answer depending on how it goes. But yeah, our first question is, would the U.S. be under regulation of the Tobin Tax? And if not, would each country have to set up their own tax system based off of the Tobin Tax? And yeah.
Sorry, could you repeat the question?
Sure. Okay. Would the U.S. be under the regulation of the Tobin Tax? And if not, would each country have to set up their own tax system based off of the Tobin Tax?
Each country would not have to set up their own system based on the Tobin Tax. The Tobin Tax would just be a standard amount that would be placed upon each currency transaction that is made in the global financial market. So the U.S. is not under this form of tax regulation right now. This form of tax is not being implemented right now. It's just a proposal. But yeah, they wouldn't have to institute a new tax system. It's just, it would be a set percent of all currency transactions, and yeah, it would function in each country.
All right. The second question we have is, how are the financial markets a better redistributor than the government is? You mentioned that in your most thing.
Well, we can see that the government's, trying to take a role in, making the situation better right now. But what I was saying in that the private sector is a better allocator of wealth. Well, I'm speaking to the bailouts, and I'm speaking to some of these other huge government moves that, well, clearly haven't worked out. Obama said that he'd have jobs for shovel-ready jobs, and he said that with his stimulus, we'd be out of this disaster. And it's clear that if it was to our side, it's clear that if it was left to the private sector, they check and balance themselves. They don't need the government to step in and to regulate that process.
Thank you. We have a few more questions. If anyone at some point would like to answer more questions, that would be great. Okay. If the global financial markets are not casinos, then how do you propose that we deal with some of these financial crises, like with Greece, besides regulation? Well, yeah.
Well, I think that's a question everyone's trying to answer right now. With Greece, I just had the experience of going to Rome and Greece last semester, and it was interesting speaking to the Greeks, and asking them what they should do about the problem. What many of them said is they're absolutely prepared to fail, and by failing and by dropping the euro, by going back to the drachma, they could start from anew. They could start from afresh. The people that regulate the euro don't want them to fail because it's clear that they're connected to the euro, and dropping them would, there's the term pigs. You've got Portugal, Ireland, Italy, Greece, and Spain. They'll all fail if we leave Greece to go back to the drachma. But my side would say that indeed, if Greece failed, that would be the better situation without government regulation.
All right, thank you. We have one last question on hand.
I'd like to add to that.
Yeah. Oh, okay. Thank you.
So I also had the chance went to Greece with June last year. So the feeling we got from Greece that people were willing to be a failed state because they believe if they accept the regulation which were posed on Germany and France, they will suffer a long time lost because their tax will be regulated, their government spending will be regulated. So they do wanna decide their own future instead of let other state to decide what you should do in the future. So this is just one response.
Good points. All right. And we have one last question on hand. So after this, unless we get more on Twitter, I will start asking for questions. Okay. So, right. So to the other side, we have, will this Tobin tax, will these regulations deter traders in the financial market?
The Tobin tax would not deter traders because this is such a small percent of tax. 0.01% is so little that they have more interest to trade than to be deterred by this. So this wouldn't deter them from trading at all. It would just hopefully make them think a little bit harder about what they are using to determine the values of these currencies on, rather than using these computer algorithms that don't really seem to have any merit to how they decide the values of these currencies. So.
All right, thank you. We have some more questions. All right, so what examples demonstrate the success of the free market to regulate problems in speed and innovation? I can repeat the question if you wish. Okay. What examples demonstrate the success of the free market to regulate problems in speed and innovation?
Well, one obvious example that was brought up actually in the debate was the term of long-term capital investment, in which case this bank was going under, and it looked to private investors who were able to liquefy its assets and not only help their own interests, but also help those of capital investment. And that's just one example. I believe Go can provide a few additional of Google, if what he brought up.
So like the real problem is like we need to decide like we want who plan to who. So we want the market, the people plan for themselves, or we want a government who plan for the people. The answer from our side is really simple. It's like we want people because the people have the demand. The people have the demand to the future product. For example, use the Google company and also Facebook as an example. So those companies, they already had a lot of capitals in its account. But in order to further advance their product and stay more competitive, they need more capital in the market and from the market to advertise their products, to do further research, and also to pay back its loan. Like the Google company, the example of Google company I used in my speech. So really, because of the speed and innovation, those companies can get those money soon enough, so they can always stay competitive. Especially in the modern society, everything changed so fast. In order to deal with this fast change, companies also need to do the decision fast in order to deal with the situation. Thanks.
Thank you. We have another question.
If you could repeat that previous question, I'd like to comment on it. Just if you could repeat that so that's fresh on the mind.
The last question?
The previous question, yes.
Okay. What examples demonstrate the success of the free market to regulate problems in speed and innovation?
Okay, so I just wanted to quickly comment that they're few and far between. You know, here's the deal. We can look at speed and innovation, and really what it comes down to is that speed hampers our understanding of the markets. So in the 1920s, with the fall of the Great Depression, transactions were not happening that quickly. We weren't having millions of transactions per nanosecond. But what was happening was that we did not have the capability to understand they did not have the capability to understand what was going on in those times. So by regulating and by regulating through the government the financial infrastructure, we're making sure we're putting a safe check on the understanding through which we can end up benefiting all of ourselves in our communities. Because what ends up happening when we let the free market reign is that people get marginalized in the process of trying to sort out this understanding. So I'd like to say that the elements which the free market use that benefit society are few and far between when they're not regulated. Thank you.
Well, to comment on that briefly, I would say that the biggest example of speed and innovation being kept in check is them failing. Lehman Brothers is a recent example, and the government coming in to say, you know, you shouldn't fail, that's ridiculous. And our side argues that that these gigantic companies that do use these different algorithms that have hundreds of thousands of trades per second, if your algorithm fails, you should be punished for one, but also you should fail. The government shouldn't be a helping hand in that.
One other comment, while Jeremy did explain why speed is a detriment, if you look to financial innovations, it's actually helping society. For the first time with the internet and things like that, the general public, not just traders, are allowed to actually look at the trends for stocks, and therefore are able to have a better idea of what they're investing in and not just rely on an individual, which is how it was before financial innovations.
All right, I'm gonna have to cut you off, guys, there. Our 10 minutes are up. This turned out to be a very good discussion here. So as we go, we shall continue on now to the rebuttals. So yeah, so let's go on.
You go first.
Okay, thank you again for coming today under this sort of weather condition. So, again, it's really important for us to talk about this topic because unlike a casino where people can choose to go in or leave the global financial market, in fact, people's daily life. And of course, because we are still suffering from the bad economic situation in the US right now, we are suffering high unemployment and no economic growth. Of course, at this moment of the history, people will have questions and people will be worried about for the global financial market. because the harm has done lots of, so because the harm people have suffered makes them question those Christians. But however, if we just look for the longer term of the global financial market, we can see the global financial market have done so much things for our society. The global financial market allowed companies to gather a lot of capitals in a short period of time, so the companies can use those money to advertise their product and stay competitive. And also the global financial market can collect people together, collect the trader in China to the trader in the US. It brings this world smaller. Of course, sometimes the global financial market is nothing more than a tool, although the real problem is sometimes this tool is abused by some people. And in this case, the global financial market is abused by the government. Because the government regulation, especially the idea too big to fail, really have done a lot of harm to the society. Just imagine this. Like if a person knows no matter what they have done, no matter if he robs a bank or kills someone, and at the end of the day, someone will come and save them. He doesn't need to do the rational calculation about what's the consequence of their action. That's a real problem in the global financial market. And thank you again for coming today.
Okay. I think the thank yous have been thoroughly taken care of, actually, so I'm going to jump right in. Thanks again, everyone. Okay. So first of all, I would just like to go back to the resolution a little bit and just say that, in terms of the casino, there's been all this talk of, well, it's not that the global markets have a kind of rationality the casinos don't have. Well, the fact of the matter is that, I mean, as we've stated, the amazing speed and the natural inclination to keep pursuing winnings has really skewed this rationality to an extent where it is very much like a casino. Moving on to some of their points now, I'm gonna really present a theme pretty constantly, and you're gonna be sick of it by the end. We want this, they want this, which will inevitably lead to this. We want stability. It is very possible to have regulation and still experience growth. It simply stabilizes that growth to make sure that it doesn't bottom out later on. So I really want this to resonate, and I'm going to repeat it frequently. Okay, so I think they're taking too black and white of an approach to something that is actually very complex. And we aren't proposing something that radical. We're just saying that things like financial innovation and this speed needs to be just regulated a little bit, as all the successful financial instruments that my opponents have brought up are today. So it simply makes sense to go about those kind of regulations. So additionally, so my opponents have offered all of these, such as paper money, all these instruments, but every single one of these is regulated, as I'm saying. So furthermore, every single one of these is effective and still promotes economic growth with those regulations. It's possible. Moving on to the speed now. So the Tobin Tax, I think there's been some misunderstanding about this. It's a very small tax, and it's not going to it's not going to damage transactions in any way. It's simply going to make sure that rational decisions are made before they'll go about those transactions. And moving on, then I would like to say that if there was a total absence of regulation, as is suggested repeatedly by my opponents, the free market does not have the means to prevent this marginalization, this massive income gap that we've seen in recent years, and they really don't have the means to go about the. So yeah, building upon that idea a little bit, actually. So I think this is actual class warfare. The disregard for others' assets that we have seen through financial innovations that I talked in my speech. That is totally marginalizing this entire class of people. That's true class warfare. We're not demonizing financial innovations, or speed for that matter. We're simply saying that combined with regulation, they're going to lead to stability and long-term growth rather than short-term benefits. Thank you.
All right, great job, debaters. That was a lively debate. I just want to thank everyone for staying here. It's kind of turning into a sauna in here, so thank you for toughing it out. So if anyone has any more questions, feel free to contact any of the debaters to discuss your concerns or questions. That is encouraged. And now Mr. Cromie will offer some comments about this debate. So give a round of hand for Mr. Cromie.
I tried to take notes of the many insights and suggestions and so on that came from this crowd, and I've decided I have to recommend to the regulators of this debate that they control the speed at which these young people were speaking, because I couldn't keep up with you folks. So my notes are a bit sporadic, and I can only add a couple of really insights. You all made a pretty strong case on both sides. And this is a very, very important topic. It affects all of our pension funds and our mutual funds and our economy. So I certainly agree that this is the real world and not fantasy land as casinos are in terms of its importance. I would just add two things that reflect strongly on your conclusions. One is that there really are two different things here. One is the stock market as we've known it, where you could buy and sell shares in companies. And those companies, the stock market's a very efficient way for those companies to access capital, as you said, and to expand their production or buy new products or whatever it is they do. And each of us can decide whether we think 3M or Blue Cross Blue Shield or whoever has a good bet, and we can buy shares and so on. That's a very efficient system. But that system had a whole new ballgame created in the 1980s and 1990s. And that's when companies started doing creative financial markets, financial instruments, and created a whole set of things on which you could bet your money, and credit debt obligations, debt swaps, and these were new products that were not based on a company's ability to produce products or construct houses or whatever. And you can bet on those. And then you can also, with credit default swap, bet against them. And you can buy insurance against your bets. And that created a whole new flow of money, which, as we all know, made a lot of us a lot more, our money market funds look better, our 401ks look better, people bought houses, we got cheap loans, and for 20 years, 15 years, 20 years, it was wonderful. And then it all fell apart. Those financial instruments are not stocks in a company. They are the same thing as a chip that you buy at a casino. And the casino says, this is a $100 chip, this is a $50 chip, this is a $10 chip. The chip itself is worth about 6 cents. But because the casino says it's worth $100, you pay $100 for it, and you bring it back, you get $100 back. Credit default swaps, CDOs, those things are like those chips. They make them up. They manufacture them. They're manufactured financial products. Some, as the young lady said, checks, cash, those were also manufactured financial products, and they've served us well. Some are good, some are not so good. These happen to be very, very good for 15 years and very, very bad for 3. And That's what we have to weigh when we say, is this a gambling casino or is it an investment operation? The same thing is happening on the commodities market. In 2004, we changed the national laws on commodity investment. The same thing is now happening on commodities market, and therefore you have oil demand down, oil supply up, and yet the price of oil is going up like crazy because people are betting on it. They're not investing in it, they're betting on it. They're pushing the price up so that they can sell it high and then go back to low. That may be casino operations are pretty close. It may even be fantasy land, at least for some people, and it has a very real effect on all of us. I suggested this topic because it's very, very important. It's going to be very important in all of your lives in the next 10, 20, 30, 40 years. And I wanted you all and your audience to think about this a lot. Because sometimes when you're hidden away in the great Midwest and Minnesota and Stearns County, you kind of won't ignore all those things that are going on in the world because it really doesn't matter that much here. But it does matter an awful lot. Thank you to our panelists. Next time when I'm here, you got to remember I'm an old guy. You got to speak slower. But you were terrific on it. You've done your homework and you made your cases. And I'll have to sleep tonight and decide whether I'm going to go and take my 401k out of the stock market and buy credit default swaps, or whether I'm going to go put it under my pillow. I don't know. It makes me nervous in any case. Thank you so much for everybody for coming.
Do we have any questions for Mr. Cromie? Well, I'll take a stab at a question then. So in the debate, the proposition suggested that one of the possible solutions could be something like a Tobin tax, which of course would require international regulation. Do you think that this is the best approach, or will regulation have to happen at the national level?
As I understand it, the idea of taxing every transaction at some minuscule level and thus building up a pool of funds that could be used to protect the public if these big operations do go down, as they will, some of them will eventually. That's one way to protect it. When they passed the Glass-Steagall Act in 1936, they found another way to protect it. They said, if you're going to bet on these financial things, you have to keep, at that time, 18% in reserve in case it goes bad. And that eventually got dropped to about 12%. And the banks were checked. They could not take your money and invest it without putting aside 12% in case it failed. They don't want to do that anymore. The Barney Frank Dodd bill is saying they have to do that, and they're fighting that. So the idea of a minuscule tax on every transaction is an alternative to that, to build a pool of funds. The international community would have to decide who's going to collect that where. The exchanges will probably have to collect it when it's happening, but credit default swaps are not on the exchanges. They're a totally floating operation. Nobody knows how many there are, who has them, how many they bought, how many they've sold, what the value is. So they'd have to find a whole new way to record those and then take the tax on those investments. That's new territory. Would it solve the problem? It would certainly give you a pool of money to go to in case one or the other went bad, to protect the public, not the bank that failed. The other interesting player in all of this are the ratings agencies. As you know, they rated most of this stuff AAA. And everybody bought it because it was AAA, because it used to be when S&P or the other ones said, this is AAA, we all use the term AAA, that's top-notch stuff. they were either lazy, incompetent, or crooked when they rated these credit debt obligations as AAA when half of them were full of subprime mortgages. They didn't do the homework. They were paid to rate them. They rated them high. John Paulson, an individual investor, hired a bunch of people like this team here and put them in a room and said, I want you to take all 10,000 of these mortgages in this one CDO and analyze them and tell me whether they're good, bad, or indifferent. And it took them 4 months to check up on 10,000 mortgages. And they checked and they came back and said, Mr. Paulson, this is crap. Half of this is going to fail. And John Paulson, a one trader, took the time to investigate. And he, being smart, then went to the banks and said, I'll bet that's going to fail. I'll give you $100,000 if you guarantee me that's not going to fail. And I'll give it to you every year. Because he knew it was going to fail. And so he started the default swap arena. John Paulson made millions when the rest of it failed. Billions, almost. John Paulson is still out there. Credit default swaps are still out there. We're all at risk. We're all at risk on those. And in terms of Europe, the wonderful thing Michael Lewis said in his book, right now Europe is in the position of the German bankers trying to make the Greek people act like German people and be very careful with their money and only invest in and so on. And the German banks are acting like Greeks by investing in a whole series of bad, potentially bad investments in order to earn 9 or 10 or 11%. He said, it looks like another disaster coming because the Greeks are never going to behave like Germans and the German banks are never going to succeed behaving like Greeks. So that's another way to look at this wonderful world. Thank you so much.
Thank you so much. I want to thank you all for coming out tonight, and hopefully by the time we're done, we'll be in a whole new climate pattern. I want to thank you all for participating in civic debate. I think the McCarthy Center is really all about promoting this kind of dialogue, which is what is going to eventually help us work our way out of this problem. It's certainly the lack of it may have been what got us into this. I want to take a little bit of time to thank some people that haven't been thanked during this debate, which is all of the debaters. And I also want to include Caitlin Coleman and Hannah DeBlowy in this group. These students worked really, really hard over the past 6 weeks, delved into topics that they had no real idea of. And this kind of effort and this kind of motivation is, I think, very exemplary of St. Ben, St. John students. So I want to take a moment to really recognize the work of all the debaters. So. Thanks again to my colleague Terry Check, who played a really instrumental role in helping the students craft their arguments. Thanks again to the McCarthy Center. And a special thanks and welcome to John Cromie during your time here in residency. We all look forward to learning a lot from your insights. Thank you very much for coming tonight.